Hi there, it's Friday the 10th of January 2020. Happy New Year. Welcome to ITB. Let's get started. As you know, the last ITB video was on the 20th of December, which is 3 weeks ago. There are a number of important stories which emerged during the first 2 weeks. I've included those stories in today's video, but to distinguish them from this week's stories, they're marked as catch-up stories on the relevant slides. In Austria, the tax authorities have issued guidance on the 5% digital advertising tax, which is effective from the 1st of January 2020. For a copy of the guidance, please go to our website or app. In Italy, the 3% digital services tax is now law and is effective from the 1st of January 2020. The first DST payment will be in regard to the 2020 financial year, and it will be due on the 16th of February 2021, and the first DST return will be due on the 31st of March 2021. And the dispute between France and the US in regard to the French DST is continuing. The most recent developments are these. The US Trade Representative has conducted a public hearing on proposed tariffs on French imports. French Finance Minister Le Maire stated that if US tariffs are imposed, France would immediately commence WTO proceedings. Finance Minister Le Maire then had a lengthy telephone conversation with Treasury Secretary Mnuchin, in which they agreed to work on a compromise until their next meeting, which will be at the Davos World Economic Forum, which starts on the 21st of January. And EU Trade Commissioner Hogan will be in Washington next week to discuss EU-US trade disputes, which will include the French DST. And in regard to Pillars 1 and 2, Ireland's Finance Minister has stated that the country's revenue loss could be in the range of 800 million to 2 billion euros. For a copy of the Minister's statement, please go to our website or app. In regard to major trade disputes, all roads next week lead to Washington. First, the China-US Phase 1 trade agreement is scheduled to be signed in Washington next week. For a copy of the report on this topic by the Chinese government news agency, please go to our website or app. And second, as I've already noted, EU Trade Commissioner Hogan will visit Washington next week to meet with US Trade Representative Lighthizer to discuss trade disputes. The EU and US have a number of trade disputes, in particular in regard to US tariffs on steel and aluminium, the long-running dispute in regard to subsidies given to Boeing and Airbus, and most recently, DSTs imposed or planned in several EU member states. And the talks will also cover reform of the WTO, in light of the fact that the US has effectively neutralised the WTO's dispute appellate body. The OECD has published its 2018 peer review report on the spontaneous exchange of tax rulings under BEPS Action 5. For a copy of the report, please go to our website or app. And the OECD has also released additional guidance on CBC reporting. For a copy of this guidance, please go to our website or app. In Japan, the Ministry of Finance has announced that the government has approved the proposed 2020 tax reform package, which are summarised in ITB on the 20th of December. The ministry's announcement provides a description of the package. For a copy of the announcement, please go to our website or app. In regard to Malaysia's service tax on inbound digital services, the government has gazetted amendments to regulations and the introduction of new exemptions. Both of these instruments are effective the 1st of January 2020. For a copy of both instruments, please go to our website or app. There have been some developments in regard to the indirect share transfer dispute in Nepal, which concerns Axiata. I covered this topic in ITB on the 3rd of May. Here's a quick reminder. The dispute concerns Ncell Private Limited, a Nepalese company which operates a mobile phone network in Nepal. 80% of the shares in Ncell are owned by a company called Reynolds Holdings Limited, which is incorporated in St Kitts and Nevis. Reynolds was a 100% subsidiary of a Norwegian company within the Telia Group, which is headquartered in Sweden. That Norwegian company sold all the shares in Reynolds to Axiata Investments UK Limited, a UK subsidiary of Axiata, which is headquartered in Malaysia. The Nepalese tax authorities initially pursued the Telia Norwegian company for capital gains tax on the sale of the shares in Reynolds. However, the Nepalese tax authorities are now looking to Ncell itself to pay the asserted tax liability. There are two recent developments. Firstly, the Nepalese tax authorities sent a demand letter to Ncell on the 6th of December, demanding that the company pay an amount of approximately $195 million in tax, interest and penalties. And secondly, Axiata has commenced arbitration proceedings under the Nepal-UK Investment Protection Treaty. The arbitration panel has issued a provisional order which purports to restrain the Nepalese tax authorities from taking further action in this matter pending the outcome of the arbitration. Axiata has issued a press release on these developments. For your copy, please go to our website or app. In Singapore, the tax authorities have issued updated GST guidance in regard to the transfer of a business as a going concern and 4 other excluded transactions. The transfer of title to goods under a hire purchase agreement, the transfer within a corporate group of qualifying income tax deductions, the issue of carbon credits, and the use of digital payment tokens as payment. For a copy of this guidance, please go to our website or app. Austria has a new government, a coalition between the People's Party and the Green Party. The new Chancellor is Sebastian Kurz, who was previously Chancellor until May 2019. The coalition has set out its ambitious agenda, with tax cuts and climate change being top of the list. In regard to corporate income tax, the coalition has stated that the tax rate will be reduced from the current 25% to 21%, over the course of the next 4 years. There has been no indication of the precise timing of the reduction. This proposal supersedes a similar proposal by a previous government. And in regard to climate change, the coalition proposes a revised target of carbon neutrality by 2040 instead of the previous target of 2050. In the EU, a report has illustrated a different way to estimate the so-called VAT gap, the amount of lost VAT revenue in the EU. The report is called the EU Self-Surplus Puzzle, an indication of VAT fraud, and it's published by a research network based in Munich. The report's abstract says this: the world runs a trade surplus with itself. The reported values of exports exceed the reported values of imports. This is a logically impossible but well-known empirical fact that must result from measurement error or from possibly fraudulent misreporting. Less well known is the fact that in recent years, more than 80% of the global surplus is a trade surplus that the EU has with itself. In this paper, we show that this EU self-surplus amounts to a striking €307 billion in 2018. We argue that a large fraction of the EU's self-surplus puzzle seems related to fraud in value-added tax. The resulting loss in tax income could amount to as much as €64 billion per year. For a copy of this report, please go to our website or app. In France, Parliament has passed the 2020 Finance Bill, which are covered in ITB in October. An interesting provision in the bill introduces a 3-year pilot program to allow the French tax authorities to exploit data posted on online platforms, such as social media platforms. Immediately after Parliament passed the bill, this provision was challenged before the Constitutional Court on the basis that it infringes on privacy. The court, however, ruled that the provision is constitutional, provided that the tax authorities limit their searches to information which has been made public by the user and which is not password protected. Also in France, the tax authorities have issued guidance on the VAT reporting obligations for online platform operators, generally effective from the 1st of January 2020. For a copy of the guidance, please go to our website or app. And finally, in France, Finance Minister Le Maire has stated that the government will start reducing the country's significant level of production taxes in 2021. Commentators have estimated that France's production tax revenues are 7 times more than Germany's. For example, 3 important production taxes are the Corporate Social Solidarity Contribution, the Contribution on Business Value Added, and the Business Property Contribution. An influential paper on this topic was published in June 2019 by the French Council of Economic Analysis. For a copy of this paper, please go to our website or app. In Finland, the tax authorities have issued guidance on recent amendments to the tax rules which apply to investment funds. Those amendments are effective the 1st of January 2020. For a copy of the guidance, please go to our website or app. In Italy, the budget law has been enacted and published in the Government Gazette. I have 4 items to mention. Firstly, as I've already noted, the 3% digital services tax is now effective. Secondly, the notional interest deduction, which was repealed last year, has been reintroduced, effective from 2019. The interest rate is set at 1.3% on net capital increases made in a company. Thirdly, a new tax credit incentive is introduced for investment in certain qualifying assets acquired in 2020. and the R&D tax credit has been modified and extended to apply to expenses in the innovation and design fields. And finally, the previously scheduled VAT rate increases have been postponed until 2021 and 2022. For a copy of the budget law as published in the Gazette, please go to our website or app. In Moldova, the government has postponed to the 1st of April 2020 the imposition of VAT on inbound digital services. The original start date was scheduled as the 1st of January 2020. In Poland, the government has issued guidance in regard to the VAT split payments system, which operates on both a mandatory basis for certain B2B transactions and a voluntary basis. For a copy of the guidance, please go to our website or app. And speaking of split payment systems, the Romanian government has announced that its mandatory form of the VAT split payment system will be abolished effective the 1st of February 2020. This is in response to a request from the European Commission to do so, as the system was not in accordance with the EU VAT directive and the freedom to provide services. The voluntary form of the system will remain in place. In Spain, a new coalition but minority government has taken office this week. The coalition has published its legislative agenda. In regard to taxes on companies, the agenda contains a number of items in the 2019 Finance Bill, which has not yet been passed by Parliament. Let me quickly go through the list. First, the introduction of a digital services tax. Second, the introduction of a financial transactions tax. Third, amendments to the participation exemption for dividends and capital gains. These amendments will reduce the level of exemption to 95%. Fourth, the introduction of a corporate alternative minimum tax for large companies, which would be imposed at a general 15% rate and an 18% rate for financial institutions and hydrocarbon companies. And finally, greater control will be exercised over CCAVs and increased conditions will be introduced for CCAVs to enjoy a preferential tax rate. For a copy of the Coalition's legislative agenda, please go to our website or app. In Switzerland, the Federal Supreme Court has decided a case in regard to the beneficial ownership of dividends which were received as part of a stock lending transaction. A Luxembourg resident company borrowed shares in Swiss companies from counterparties resident in country X under a standard stock lending agreement. The borrowing was made before the share's dividend declaration date. The dividend withholding tax rate under the Switzerland Country X Treaty is the same as the rate under the Luxembourg-Switzerland Treaty. Under the stock lending agreement, the Luxembourg company paid a so-called manufactured dividend to the counterparties. The Swiss companies paid dividends to the Luxembourg company, which claimed the benefit of the tax rate limitation under Article 10 of the Luxembourg-Switzerland Treaty. The issue in the case was whether the Luxembourg company was the beneficial owner of the dividends, and therefore whether it was entitled to the tax rate benefit under Article 10 of the treaty. The court held that the Luxembourg company was not the beneficial owner of the dividends due to the obligation to pay manufactured dividends to the counterparties under the stock lending agreement, and thus the treaty claim was denied. This decision is consistent with prior case law in Switzerland, in particular the total return swap case in 2015. However, commentators have criticised the decision on the basis that it does not apply long-standing tax authority guidance, Circular 13, on securities lending transactions. In the UK, the upper tribunal has decided a case in regard to the VAT rate to apply to digital newspapers. The VAT legislation provides for a zero rate to apply to the supply of newspapers, journals and periodicals. The tribunal held that as a matter of statutory interpretation, and in particular the always speaking doctrine, that phrase includes digital versions of newspapers. For a copy of this case, please go to our website or app. Two members of the Gulf Cooperation Council, Oman and Qatar, have published their 2020 government budgets without including any revenue from VAT. Commentators have taken this as a clear sign that VAT will not be introduced in those two countries until 2021. So far, 3 of the 6 GCC members have introduced VAT: Saudi Arabia, UAE and Bahrain. In Argentina, the tax reform bill, which I described in ITB on the 20th of December, has been enacted into law. As I noted then, the legislation includes 2 major items. Firstly, the introduction of a 30% tax on the purchase of foreign currency. And secondly, a suspension of the scheduled tax rate changes impacting companies. The reduction in the corporate income tax rate from 30% to 25%, and the increase in the dividend withholding tax rate from 7% to 13%. For a copy of the final legislation, please go to our website or app. Also in Argentina, 2 important local governments have each introduced a 2% turnover tax on digital services provided by non-residents. Each tax is to be collected by withholding by the resident payer, or if a payment intermediary, such as a credit card company, is used, the withholding obligation is imposed on the intermediary. In Chile, you might be wondering what's happened to the amended tax reform bill, which the government and major opposition parties agreed to in November. Well, it's currently in the Senate. If it's passed there, it must then return to the lower house for final approval. In Colombia, Law 2010 has been enacted. This was necessary after the 2018 tax reform bill was ruled as unconstitutional by the country's constitutional court for procedural breaches. Law 2010 is similar to the 2018 tax reform bill. For a copy of Law 2010, please go to our website or app. In the US, Treasury and the IRS have released proposed regulations concerning the source of income from certain sales of personal property, including inventory. According to the summary at the start of the proposed regulations, these 3 topics are covered. I won't read them out. Please hit the pause button to study this list. For a copy of the proposed regulations, please go to our website or app. The US Tax Court has decided a case in regard to a provision in the UK-US treaty which deems a permitted establishment to exist in regard to certain offshore exploration and exploitation activities. That provision is Article 21, the relevant paragraphs of which I have set out here. Let me point out a few things. If you look at paragraph 1, you will see that activities which are carried on offshore in a contracting state in connection with exploration or exploitation of the seabed are defined to be exploration or exploitation activities. And if an enterprise is carrying on exploration or exploitation activities in a contracting state, paragraph 2 deems the enterprise to have a PE in that state. That phrase, in connection with, in paragraph 1, was a key issue in this case. The taxpayer is a UK resident company. It owns a multi-purpose support vessel. The UK company chartered the vessel under a time charter to a US company. Under the time charter, the UK company was required to provide the captain and crew of the vessel. The US company used the vessel to undertake decommissioning of third-party oil and gas wells on the US continental shelf. The court held that the decommissioning activities were a necessary component of exploitation. It also held that the UK company's activity in chartering the vessel to the US company was in connection with the US company's decommissioning activities, and therefore that chartering activity was in connection with exploitation. And consequently, the court held that Article 21(2) applied to deem the UK company to have a PE in the US. Now, a couple of questions might occur to you. Firstly, did the UK company have a fixed place of business PE under Article 5(1)? The IRS conceded that that was not the case, and I can think of a number of reasons for that being correct. For example, I would speculate that the vessel was probably not stationed in one specific geographical place, but instead moved around a large area of the continental shelf. And the vessel had been leased to the US company, and so it was not at the disposal of the UK company, despite the presence of the captain and crew, who incidentally were not employees of the UK company, but instead were employees of affiliates. So quite a number of reasons why there was no Article 5(1) PE. And a second question is, why did Article 8 on shipping profits not apply? If Article 8 did apply, it would give exclusive taxation rights to the UK, regardless of the existence of a PE in the US. And as you probably know, the OECD commentary to Article 8 states that it applies to profits derived from time charters. However, the court answered this question by deciding that the vessel was not operated in international traffic, as that term is defined in Article 3(1). Firstly, the vessel was not engaged in mere transport of passengers or goods. And secondly, it was operated solely between places in the US. For a copy of this case, please go to our website or app. And now for this week's treaty developments. We've had 3 treaties signed and 7 treaties enter into force. I have 3 articles for you this week. The first article is called Rocky Shoals Ahead for International Tax. It's written by Mindy Hirschfeld and it's published in Tax Notes Today International. This article both looks back and looks forward. It looks back over the last decade to review the major changes which have impacted the world of international tax, FATCA and the Common Reporting System, the original BEPS project, US tax reform, BEPS 2.0, and their causes: distrust of multinationals after the global financial crisis, technological innovation, income and wealth inequality. It also looks forward to the uncertain future of international tax. In regard to the uncertain future, the author writes this: there are concerns about the continued legitimacy of the process for developing international tax rules. Although the OECD managed to maintain a role as a global rule setter with the BEPS project, unhappiness with some of the recommendations thrust the organisation into phase 2 of a mission to develop rules for taxing the digital economy. As a result, the United States and others expressed reservations about the OECD's process for developing rules. If this latest project fails because the OECD can't maintain consensus among a working group of countries, the infrastructure that for the last 75 years ensured a somewhat cohesive and coherent set of rules to guide the taxation of cross-border investment will unravel. Without faith in some type of global rule-making body, there's no reason for countries to avoid acting unilaterally, as they see best to optimise their own revenue and investment positions. The second article is called Mexican Tax Reform in Between BEPS 1.0 and BEPS 2.0. It's written by Kern Van Heck and it's published in the CLUA International Tax blog. This article focuses on a significant part of Mexico's 2020 Budget Act, namely a rule that disallows the deduction of any payment to a related party that is subject to a preferential tax regime, which is defined as an effective tax rate of less than 22.5%. The article compares this rule with the undertaxed payments rule in Pillar 2 of the Inclusive Frameworks Digitalization Project. The author comments, the Mexican rule may represent an example of a unilateral and premature implementation of Pillar 2 before the effects of BEPS 1.0 have been evaluated, and before a coordinated and uniform global design of the GLOBE rules have been developed. Mexico is probably one of many capital importing countries that attribute much more importance to the UPR rather than the income inclusion rule under Pillar 2, considering the relatively limited outbound investment base and the existence of CFC rules and a credit method for the avoidance of double taxation. And the third article is called The Arm's Length Principle Works Just Fine Most of the Time. It's written by Oliver Treidler and it's published in Tax Notes Today International. The author writes at the start, this article considers whether a pragmatic application of the arm's length principle remains viable in an increasingly globalized and digitalized economy. Specifically, it will scrutinise two of the most frequently raised assertions made by critics of the arm's length principle. Namely, 1, the alleged increase in the complexity involved in the day-to-day process of applying transfer pricing rules based on the arm's length rule. And 2, the challenges involved in finding adequate comparables to determine arm's length prices and the alleged susceptibility of the arm's length principle to, again for clarification, allegedly abusive tax planning. As indicated in the article's title, the author concludes that the arm's length principle works just fine most of the time. Well, that's the way it is this Friday, the 10th of January 2020. I'm Steve Towers. Have a great weekend.